thank you everybody. If you don't mind, I've been a professor at the University of Missouri, so it's much more comfortable for me to be down here with you, so I can make sure that if somebody's sleeping, I can kick you out in the chair and wake you up. Also, I'll tell you that, oh, did we lose the screen? Also, I'll tell you, I got two sets of clothes. I got my DC clothes and my professor clothes, so no insult from the professor clothes. I figured it'd just give you more respectability down here, so I left the suit at home. We're going to talk about markets and policy. We're going to talk about, I'll give you a little bit of an outlook on markets and policy. We'll talk about crop insurance a little bit. We'll talk about climate a little bit. We'll talk about food price inflation a little bit. And so when you think about this, you might say, hey, what do I care about food price inflation? We got plenty of gasoline and meat here in Missouri. Well, I'm not worried about that. But, it does color people's thinking in DC as well, too. Happy to talk to you about other policy things also. Okay, so let's jump in. Are we getting a ton of feedback on the overhead? Okay, all right. Oh. And don't worry, I'm not going to show you like word chart after word chart, but I do want to show you this to make a point for you. So if he brings that up to the full screen. There we go. And now can I forward it? There you go. Yeah, like I said, I'm not going to show you word chart after word chart after word chart, but I think for my presentation it's important I remind you of one thing. As I said, I started on January. I started on January 3rd. Okay? Started on January 3rd. The office of the chief economist is not a political office. Right? So Secretary Perdue offered me the job. I accepted the job. When there's a change in administration, all the undersecretaries change. The chief economist does not change. And I bring this up for you because, one, I don't want to make news today. That's the first thing. And second, you shouldn't take me as the policymaker at USDA, because I'm not. I'm kind of the person that sits in the back and says, that's a good idea or that's a bad idea and here's why. Okay, but I'm not a policymaker at USDA. So for these new folks, the crew that's there, I want you to keep, they have their principles overlying a lot of their actions. And so these are their principles, so we'll kind of talk about how these intersect lots of things as we go through. And when you think about aspects of policy, everything from, think about crop insurance. We'll talk about crop insurance. How do these things fit into crop insurance? These are kind of their pillars that they put forward and say, hey, here's some broad things that are important to us. Outside of the normal things, hey, here's a philosophy. Okay. So I think the other important thing we want to do is we want to talk about how we got where we're at in agricultural markets. And a lot of the things I'll show you are the things I show these folks as well, too, to remind them, hey, where we're at. And I show this graph to them because I want to remind them how different the sentiment was in the ag sector prior to August 2020 than it is after August 2020. Right? It's a completely different world when you think about where commodity price is headed post-August 2020 and the anxiety involved in it and the start of the run in ag prices. So all I'm showing you here is futures markets for corn, soybeans, and hogs, right? And those vertical lines there with the arrows are just August 2020, right? So pre-August 2020, post-August 2020, a heck of a run. And so when I explain this to folks, here's what the sentiment looks like pre- and post-August 20. And so why did we have this shift? We'll talk a little bit about why we had this shift before we talk about policy. So, like any good economist, as we started the beginning of 2020 now, I'm thinking, okay, I know where cattle prices and hog prices are headed. They're going to go lower. Okay. I was right, but for absolutely the wrong reason. I have to admit that. Got it the right direction, absolutely the wrong reason. I'm thinking we're heading into a COVID impact. Economy's going to contract. Folks are going to, pull back on beef and pork consumption. It was the opposite, right? We had a fall in animal prices, but because we had that processing spread where we had no labor in slaughter plants. But part of this also, when we see that these gains in prices, an expectation might have also been, hey, we're going to have a contraction in trade. That's the Great Recession there in 2008-9. Okay, this is going to be at least as big of an impact as the great economic impact as the Great Recession. We're going to have a contraction in trade. In fact, ag trade fared very well during COVID, and has. And that's part of that post-August 2020 story. This is brand new from yesterday, released by USDA yesterday, which looks at both ag trade for 2021 and now the first forecast for ag trade of 2022. So this is the first look forward into fiscal 2022. It shows you, hey, ag trade, record high at 21, record high at even higher. This is value, right? So an even higher value of trade in 2022. Trade clearly playing a role in what we're seeing in agricultural commodity prices. And here's kind of your look at this. So here's 20, 21, 22. So here's the last 3 years on this. And you can see the bulk commodity export prices and how those are making a contribution to what we're observing in our own domestic prices as well. And I'm not going to spend tons of, we talk about this for several hours about who's buying, why they're buying. But this is a big part of why you're seeing commodity prices where they're at, but not the only reason. I'm focusing on trade here a little bit, but here's also meat trade. And it's a little bit hard to read in there, but we get a pop in pork trade from China when they start to have their ASF problems, and we come out of our trade friction with them. But beef has also been another area where we've done well. Trade still represents a smaller share than pork, obviously, and small to China, but trade has been excellent for beef as well too, given those meat values for trade. That's a big contribution here to our overall trade now. And that chart I showed you before said, hey, we had a couple years there when we were actually borderline net importers in terms of ag value. This brings us solidly back into having a positive net trade balance. We export more agricultural products once again than we import. That's where we want to be. So here's part of it, and I think that there's two ways to read this graph, right? Well, there's more than two ways, but the two ways I look at this is China comes back into the market very, very strong. They were as low as number 5 in our trade partners, bounced solidly back to number 1, hold it there in 22. But the other way I read this is, what's everybody else doing in 21 and 22? They're not contracting, right? It's been pretty amazing that when the Chinese come in so solidly to our ag markets, that everyone else hasn't pulled back, right? And that's another way we've seen supported prices, right? You're looking for folks to ration demand, and at the moment, everybody's saying, no, you ration demand. I'm going to keep taking it, right? So that's another good, and this is updated as of yesterday as well, too, with that new trade number for China. So I'd also say we've had very robust domestic demand for a lot of commodities as well, too. Soybean crush. 2020 was a record high for per capita meat consumption in the United States. So in the midst of the pandemic, again, economists getting things directionally right, but for the wrong reason, we didn't, got animal prices right, but I wouldn't have guessed more meat consumption. We did, whether that's a result of disposable income, I can't spend this money in a restaurant, so I'm going to instead buy a really nice piece of meat. We've had really solid, I think domestic demand has been really one of the reasons we've seen such good meat strength, trade, and domestic demand for the crop side as well, too. So, Drought Monitor. I'm an Iowan by birth, now spent more time here in Missouri than Iowa. But I look at Des Moines, Iowa. You folks know where Des Moines, Iowa is. Everything north and west of Des Moines, Iowa, pretty dry. Everything east of Des Moines, Iowa looks pretty darn good. So let's talk about this year's crop a little bit in terms of an outlook. Now, this is principal crop area that NASS has reported here. So when I look out here, I see this is principal crop area planted for 2021. And now this is, they start out asking farmers, what are you going to plant? And then they try and go back and survey them and say, what did you plant? Okay. I found this one to be a bit of a surprise because look where prices are at and look where total principal crop area is at. So that may be a question for you all, which is, why did we not bounce back on principal crop area as much as we might have expected given where prices are at? So given where prices are at, we're more in the price area now of these years. These years are pretty low prices. Those last two, they're 18 and 19 are prevent plant, remember. a lot of folks, including you in the previous year, had trouble getting the crop in, right? We had a lot of prevent plant. That's why those 2 years are so low. But when we bounce back into more normal planting weather, why did we not get back to where we were when prices weren't this high, or even higher than that still? Right? But this is where we're at. We're at this type of crop area. Does it take more time? Are there other issues associated with it? Not CRP, but you know, where are we at with respect to this? So let's talk a bit about global markets here. And this is a very simple look at production and consumption. So are you producing more than you consume, or vice versa? And I think when you look at this, I've circled this year, we're just finishing up now, and then the next one is the one looking forward, and you can see it's been a pretty tight year. We've had consumption running greater than production, and even out there in wheat, where we've had several years of production exceeding consumption and building global stocks, we're now back into the position where we're actually drawing down global wheat stocks. So in this, you know, we started out, I think corn and beans on trade were really pulling up everything else. They were leading the crop side, and wheat was really being pulled along for the ride. I think this latest report, thinking about what that Russian crop looks like, has now said, okay, wheat said, now it's my turn to kind of pull along and catch up as well too, because we started out the year looking at that crop thinking we were going to build stocks for another year. Not in that position. Okay. But it hasn't been the same for winter wheat and white wheats. You can see that the drought didn't have as much of an effect on our winter wheat crop as we might have expected, but it's really decimating our spring wheat crop. So when you think about this, when you think about stories of, hey, bread wheat or pasta, you know, durum wheat, those spring wheats are getting pretty hard hit by that drought. And it is affecting other things. When we look at cow slaughter as a percent of herd, we're already in a contraction phase for the cattle market. That drought is probably not helping that, right? We're having cow slaughter as a percent of that herd in excess of what we might expect. Drought's part of that. Okay, I'll make all these slides available to you as well too. But if you kind of look at this, my point being here now you're looking at wheat prices. When you see prices from USDA, I'll make another point for you as well too, which is these are prices received by producers. And when you drop off your corn, if it's forward contracted, the price is recorded on the day you drop it off. Okay? So it tends to lag prices on the way up and lag prices on the way down. Okay? Just to put that in your mind here. But what you got here is really, trimming exports, trimming ending stocks. We're tightening up the U.S. wheat market, even though our winter wheat production was decent. And actually, we have a long-term trend, downward trend of wheat acreage in the United States. It actually bounced back that last year, right? And why is wheat acreage trending down? It's not because we're not good wheat producers. We're great wheat producers. We're just better corn and soybean producers, even than that, right? So our comparative advantage has, over time, shifted to corn and beans. But here, we're again tightening that wheat market up. Okay, let's talk a little bit about corn and beans. Again, reminding you, kind of put your eye on Iowa, Des Moines, Iowa, north and west. You can see those yields pretty clearly. You can kind of see, when we look at principal crop area, you can kind of see western areas with acreage, more acreage below the previous year. You can see some of that. That's a little bit of a drought effect. Here you can clearly see the yield effects on corn in those areas, right? Still a good-sized corn crop. What is that? Still the second biggest corn crop that we've ever produced. Still the second biggest corn crop we've ever produced. And yet, we are not building significant stocks coming out of that crop is our expectation. And when you look at this, you've got, a little bit of a rebound in ethanol grind, so a little bit more corn going into ethanol, but exports also coming back. We had a really great export year last year because the Ukrainians, probably other North American hemisphere competitors, didn't have great crop. And the Brazilian second crop corn, also not great. So we had a good export year in part because our competitors had a bad export year, and there was a pretty good solid amount of demand. And when the Chinese were thinking about feed grains, they were focused pretty narrowly on corn, which they haven't been in past years. Okay. Soybean yields, kind of the same thing. I'm blowing this one up here, but you can see the same pattern, right? Minnesota, North Dakota, South Dakota, low yields. Illinois, Indiana, Ohio, Pennsylvania have the little pound sign after them, record yields. Right, so that's what the market's trying to balance. Pretty bad yields north and west of Des Moines, Iowa. Iowa being pretty mediocre. Really great yields going west. Sorry, east. Oh. Okay, but here we were already incredibly tight. 160 is incredibly tight. We were six times higher than that just 2 years ago when we had trade friction. We have whittled those stocks down incredibly rapidly, tightened this market up. The one that I really point you to is crush is actually up year over year, while exports are down year over year. We have an incredible crush demand domestically, and it's pulling off a lot of that excess soybeans. It's not excess, it's competing with exports. What's part of that? Soybean oil prices have been tremendous. Soybean oil prices have been tremendous. So what you have here is you got a little bit more pull in crush this year than you do in exports because domestic demand for beans and domestic demand for oil in particular has been tremendously strong. I think when you think of the outlook of beans, the pace at which the Chinese were taking in soybeans for decades was incredibly strong relative to changes in things like their hog herd, right? But that makes sense, right? We're going to slowly convert over from swill feeding and feeding other things, and soybeans is the easiest thing to get into China relative to corn and other things. So we're going to take in beans, and so that growth rate was very strong. So I think one of the things that we don't know, so one of the things that gives us a smaller growth in intake in China is their hog herd seems to be coming back from African swine fever, has this worry about biological controls, worry about ASF, push them quickly to go to commercial feed, but also more efficient commercial feed. So I think what we don't know is there's a lot of uncertainty how that shakes out, but I think we're coming down to a more normal commercialized growth rate in annual consumption of soybean within China. Here's the share of soybean oil in a bean, right, in the last year. The oil value is now pushing nearly 50% of the value of the bean. That's not the normal way it happens. It's usually about a third. Soybean oil has really taken off. That's what's pulling crush margins. That's what's keeping those beans at home. Biofuel policy is part of what's going on here. So what you have is you have biodiesel. I think when you and I think about biodiesel, we think about smallish plants sprinkled across the Midwest. The new plants in biodiesel are being set up by the very people who are obligated to blend it. So all the refiners. These are big plants. They're being either located next to a petroleum refinery or right in there with the petroleum refinery. They're big. And so part of me says, that's a big bump in demand. These are big plants. And part of me says, where's the competition between these big petroleum company biodiesel plants and the ones I think about more traditional producers in the Midwest? And is there a competition there? And does everybody make it? Right? But this is certainly one of the factors that is leading to strength to bean prices, strength to domestic crush, through oil prices, is this process. And the other part of this process is those folks who do renewable biodiesel specifically need a refined product. They can't use crude oil like the famed producers in Iowa do. They need a refined product. So we also have a choke point in soybean oil refining. So you see if you want refined soybean oil, those prices have skyrocketed. So let's talk about farm income really quick here. This is from February. The new one comes out on the 2nd of next week. Okay? So think about, again, I'm not going to front lead what they're going to forecast for farm income, but I want you to remember this was done in February. Think about where commodity prices went since February. but also keep in mind what costs have done since then. So I don't want to repeat what they might say, but keep in mind this is from February. But again, the things that were leading your cash receipts higher: corn, soybeans, hogs, all the things an Iowan could love, and all the things that the Chinese are buying, and beef as well as another part of this, right? So when you looked at this in February, the things going and helping support farm income, those products leading it forward. I think the other important part of this is, we're coming off some big ad hoc payments, direct payments to producers from big, unusual events. So what I got labeled here is at MFP. That's your market facilitation payment. That's your offset to Chinese trade friction. Okay? That's the orange one. The gray one is coronavirus food assistance, and anticipated coronavirus food assistance for 2021. And so what you can see is you end up with record large government payments and them coming back down. Okay? Coming back down to the point where in February, the expectation was it'll still be a really good farm income year, but not as good as the year where you got record government payments. I don't know where we'll be at, right? You might say, hey, commodity prices, receipts from the market may get closer to a complete replacement of those government payments. We may have shifted now from ad hoc payments. In any case, we're shifting from ad hoc payments for really unusual events to dollars from the marketplace being the supporting element for farm income. And I try to explain to folks that while they spend the same at the store, I think you all really appreciate the dollar from the marketplace a little bit more. Okay. Let's talk a little bit about crop insurance now that we've talked about. And I should tell you that as part of my new job, I'm the Federal Crop Insurance Corporation Board Chairman. And we just came out of meetings. I can't describe a lot of those meeting incidents to you because they're confidential submissions, but we can feel around the edges of general themes coming out of crop insurance, all right? But I think it's important to talk about, we've got these really big ad hoc programs, these recent actions, MFP, coronavirus, food assistance, 1, 2, a CAA, which is also a coronavirus food assistance type program, covering a bunch of different products. And then there's proposals for WIP and WIP Plus. So we've had big disaster, big ad hoc programs, payments going out under these different programs. And I just throw this out there for the implications as, the board worries about things like, is there crop insurance solution to some of these? That's just their time, their mentality. And so when you think about that, is these programs which have to be done quick, out the door, there's a real need, let's get this to producers, we don't have a year to do this, let's act. You got test beds for different programs, and you really have broadened the scope of who you're hitting in a lot of these programs, right? And that's part of the timing challenge, right? I think some of the first programs were, hey, we need to get this money out the door. How do we do that? Let's focus on folks we know how to deal with. Boom, there, that. Now, let's go in and fill the gap fill, and let's start hitting around, okay, what else do we need? Who did we miss the first time? That's part of it, but I think you'll also see, we've seen a lot of different coverages, including now out here. I think you all will report your cover crop next year, if you didn't this year, right? So, we think about the cover crop program as well too, the offset for your crop insurance. So you have these really different mix of programs, and I think that kind of influences the folks that do crop insurance saying, hey, is there something in crop insurance that crop insurance is missing that it should cover? And I just put this one up here because I want to remind you there are certain pillars for this administration that they will push. So in crop insurance, I get a sense that we will see some activities related to climate where crop insurance, so you've got your traditional programs. Are there some of these tools that can be voluntary for producers where they can take on some activities that might be risky, but there will be a crop insurance product in there to support this? And I said, you people understand risk. The risk of not kind of engaging on this front is that somebody will legislate a solution for you. And so that is where the board also is trying to think ahead of the game. how, if at all, do these things, get into the crop insurance program in a way that producers will benefit from, or can say, I can take. Okay. So I do think also when you think about their sense of inclusion, also probably gets you down here a little bit more, right? You got lots of product opportunities when it comes to corn, when it comes to soybeans. Are there ways to get additional crop opportunities down here on this other side for walnuts or potatoes or peaches? Are there opportunities down on that end as well too to provide a little broader, more inclusive crop insurance products? Now, there are some difficulties in that. But, non-dairy, the livestock programs in percentage terms have been a big success. In absolute terms, they're still pretty small, right? But they've been a big success, so this is an area where we will continue to explore and look at these things, right? So crop insurance is also livestock insurance. I've only been the head of this board for 4 months, 5 months. But this is some of my impressions, being not a crop insurance guy. Got a lot of the products already serving traditional row crop. Doesn't mean there can't be more, but you're kind of, if you're thinking in the same frame, there's not too many additional permutations. You're trying to be creative. But are there other options? Specialty crop servicing. We're trying to work through additional specialty crop servicing, but it's hard because the data are not there like number 2 yellow is there, right? It's harder to operationalize those crop insurance products, and they're more expensive, per unit. Sometimes higher value crops, though. 508H product. I don't know if you all know this, but folks will come to us and say, hey, here's a product. We're kind of down to these small crops where data are not good, and it's hard to evaluate the value of those products. So it takes a little bit extra time. And finally, I think that there is momentum for products which help mitigate risk for producers who follow climate pressure. I'm just telling you, I view that as momentum, okay? And as you all like crop insurance, you got to think about how do you broaden your base for folks who think crop insurance is great. I'll just throw that out there. Okay, let's talk about climate a little bit, and how I perceive this discussion going within USDA. So there, on January 27th, almost like right out of the gate, there's this big executive order that says, go and do this, go look at these impacts, tell us how you're going to try and tackle that. With agriculture being a big, push by this administration to be one of the folks involved in this. And that probably with some enthusiasm and some trepidation in the industry, both, obviously. Okay. And I think the real challenge here that perhaps is one place where USDA can put itself is when it comes to thinking about emissions from agriculture, we're about 10%. Okay? But when it comes to credit generation, we're like 2%. Okay, why in these voluntary, and these are in the voluntary markets, right? So 10% is our emissions, 2% is how much we get out of the voluntary markets. So why is agriculture not participating? And I think, you got to consider all, you've got all these issues in terms of farmer participation, scale, transaction costs, confusion. Each of these independent marketplaces has different criteria, limited demand, and by limited demand, I mean this is wrongly. I think when they talk about it this way, they're wrongly phrased. I think this is a limited supply issue in terms of farmers don't want to participate. Why don't they want to participate currently? This is why they don't want to participate currently. We talk about scale. So farmers, when you think about a product for sequestering greenhouse gases, you can put something on a landfill that's one spot, it's big, the volumes are large. You think about doing that on a field or a group of farms, it's still pretty small relative to those other projects. So when you start dropping out all these other costs, what's left to the farmer is pretty darn small. So why? It's not a demand issue on the credit, it's a supply issue on what the farmer is willing to supply you in terms of credit because of what they're getting out of it. When I think about these voluntary carbon markets, right? These carbon credits. So when I think about it, I think reducing these and shifting out that supply curve for agriculture to supply these credits is one of the roles that USDA can play. Right? So we have to think as USDA how to help the market in each of these areas that are farmers' concerns. Right? What am I going to get? Can we help reduce the costs, add some certainty to the marketplace, add some standardization? Number 2 yellow corn goes away. Everybody knows what number 2 yellow corn is. Is there a way to get closer to understanding what a ton of carbon sequestration is, and therefore that people know what that market is? So you got everybody knows what number 2 yellow is. You buy number 2 yellow, you sell number 2 yellow corn. Is there a role for USDA in that, saying, this is a commodity. Number 2 yellow corn plus this production practice is a commodity, and I get the value for both of it. So I think that this is where USDA struggles with a lot of it. This is where they need to struggle and make the farmers shift out their supply because they're seeing more of the benefits and they want to participate. And I think the real challenge here is there's a tension here between producers and the current carbon markets. They list everything down with excruciating detail, and producers are saying, yeah, but I have these other criteria, I still got to produce a crop, right? And so there's kind of this balance between excruciating detail and getting things done, and a lot of it has to do with offsets. Concern that if you put these practices in place voluntarily and you cut production, does it just mean more production goes to Brazil, and is there really a savings there? Right? Those are the things that the market and USDA has to kind of figure out. And am I doing okay on time? I'm doing okay. All right. So that's the climate market. Another aspect I think that kind of is overarching policy here is this issue of supply chain resiliency, and I put in here and or competition, because I don't consider them the same thing, right? I don't consider them the same thing. Some folks will jump to the answer to supply chain resiliency is more competition. Okay, define that for me. I don't know. Does taking the 10 biggest packing plants and making them the 40 biggest packing plants improve resiliency? I don't know the answer to that. I think some folks think they know the answer to that. I don't know the answer to that yet, right? I think that that's something we have to answer here. But competition, supply chain resiliency, this is a great question for economists. Really, what should this look like, right? If we want to improve the situation for cattle producers, let's make sure we don't make the aggregate situation worse so you get a bigger slice of a smaller pie. That's all I'm saying. That's when I think about this, right? So there is some tension there that, hey, make a move, but make it so the pie is not smaller. Make it so the pie is bigger. So I'm sure you all talked about this. I wish I would have been here with Glenn Tonser yesterday, because I really would have loved to hear him. But so when we look at some of these things, this is the kind of view from BC that they have as well, too. And when you look at this, you can see those cattle slaughter, and here you can see cattle slaughter and hog slaughter, and you can see that COVID labor issue where these plants are shut down because they can't get people in there. And I will tell you that when I talk to people, this is it's like a mental test if you see things as half full or half empty. Is that a huge, terrible shock that says our food system is brittle and fragile? Or is that, wow, we came back through a pandemic and look at how fast we rebounded and things just got right back on track? Glass half empty or glass half full. So this is, what you're viewing here is a very sharp contraction in slaughter. Obviously, lots of disarray. We see animal prices collapse. We see if you're selling your hogs in the negotiated cash market, you're getting hit hard. Okay? And then you have a rebound. And so I think that this is what folks look at and they think about how do we address supply chain challenges. and competition, potentially, they wrap into this as well. Because when they wrap competition into it, this is what they think about, which is, when COVID initially got started, I went out and I talked a lot, get lots of questions from the press. Cattle producers are making tons of money, right? Because I can't get hamburger in the store. No. That's, there is a wedge between there, which is the processing, which is the slaughter facility. So you got to explain to them, no, you can't have this spread, and we did see this spread, and how much of it is cost, and how much of it is other things. But I will also say, this one might even be a few weeks out of date on 21, because you can see that we're coming back on some of these slaughter numbers and the daily pork cutout values. So these are the kind of the wholesale cutout value pricing. Okay? And also explaining to folks here as well, too, that the situation in the cattle market isn't the same as the situation in the hog market. So for hogs, I take a very short-run view that says, are we slaughtering on Saturday or not? If we're slaughtering a lot on Saturday, that means that the balance is in favor of the packers, because there's a lot of hogs and they're paying little for them because they're running on Saturdays, or margins are that's kind of the swing capacity. And then I look out here in cattle and I say, hey, the situation as we went a couple decades with excess capacity, and that's really changed, right? So you kind of keep it in mind, these structural balances versus short-run impacts. I mean, the independent hog producers went from getting absolutely hammered during the height of COVID impacts on labor to ended up being a little short of hogs, and this spring probably getting a premium over contracted prices. Not a lot, but a little bit of a premium because packers were out there looking for extra hogs because they were short. So again, when you think about programs to address capacity and competition, I remind folks, hey, keep these in mind. These are important for how you think about what do you actually need to balance this capacity with animal numbers. And this is the other thing about, is it a smaller share of a bigger pie, or is it a smaller share of a pie that has got insufficiently large? And here's your kind of historical price spreads in terms of, you've got net farm value, wholesale, retail, and farm to wholesale. Okay, so you can see that these spreads so you've got labor and packing taking on an increasing percent, but that's also part of that's processing and other things as well too. But you can see, remember I showed you 2015 on the cattle side where we switched capacity? You can see it in that red gap there that actually grows, right? So you can observe these things. I think overall, you've got an increase in this because there's a lot more processing and other things going on. And you all probably talked to Glenn Tonser, and I don't want you to look at this graph too much to say, but there's a lot of cells in there. Because this is all the different ways that you can think about policy for changing cattle pricing, and that none of them really works to satisfy every need that you might have. So this is, I took this from Ted Schroeder at Kansas, and he and I talked about this. So you think about, okay, each of these different pricing schemes, and what are their strengths? The trick is there's not really a silver bullet. And that's my only point about, as we think about policy, we have to think about things that don't shrink that pie, make that pie bigger, and give the producer a bigger share. The last thing I want to talk to you all about, do I have 10 minutes? Okay. The last thing I want to talk to you all about is food price inflation. You might be saying, why do I care about food price inflation? Got plenty, like I said, got plenty of gasoline meat here in Missouri. Why do I care about food price inflation? But this is one of the things that I would argue that makes politicals anxious, food price inflation. So, keeping in mind and understanding what's going on here and how it might spill over into other activities is probably a good idea. So let's just spend a little bit of time on this because I think it kind of ties back to commodity markets as well, too. So, the dashed line is what you all get, farm product PPI. So the prices that you get, the dollars that you get is the dashed line. And then the other ones that go up, food at home is the gray one there that pops up really high, and there's food away from home. So that's kind of what the consumers are paying, right? So as you might expect, we have those COVID-related shocks. Oh, the farmers must be making a ton of money because I can only get one package of hamburger. No, because that gap widens up because that's where the money's going for those costs of slaughter and the inability to, and basically rents accruing to slaughter capacity. Starts to come back as we resolve those COVID issues, commodity market prices take off. They start contributing, farm producer PPI. They start contributing to food price inflation, but I think you and I all know that the farmers receive the minority share of the dollar at the grocery store. So it can't be all of that, right? We all know that they receive a minority share, so it's kind of holding up that retreat from solving those COVID issues. But now we're out here where, I'll be honest with you, I don't know exactly where we're headed in terms of food price inflation, because we got all those things involved in labor and transit that occur after the farm gate that also roll themselves into food price inflation. And again, I think I talked about this one earlier, so I won't spend much time on it. We had record high meat consumption in 2020. I wouldn't have guessed that. Retreated a little bit, but not a lot. Kind of that transition maybe to food away from home, more restaurant eating. I'm going to put a little bit more money into sitting down with a nice tablecloth and a little bit less money into that nice piece of meat I'm cooking myself. And so, per capita meat consumption still pretty darn strong after coming down after several years of good increases. Here is that point about what share farmers get. Agribusiness, farm production, those two little tiny slices up there, that's basically the stuff that's before the farm gate. So there's a lot of costs there outside the farm gate. That's the one on the right. The one on the left is kind of, what are those, now let's go across the farm sector and say, a whole bunch of that comes from wages, right? And only a little bit of that is wages you all pay yourself. A lot of it's wages down to the processing line all the way to the person serving the food at the restaurant. So there is a tremendous amount of wages involved in this. And so that's the other part of the unknown when it comes to food price inflation. So when I get back to this one, I say, I don't know where food price inflation is headed for sure, because I don't know where general inflation is headed for sure. I kind of think we've peaked out on farm producer PPI with some exceptions. I think beef being one of the exceptions where we'll continue to see beef prices rise, perhaps. But overall, I think maybe we peaked on commodity prices, but I don't know where food price inflation goes farther out. And I think that is all I have. So I hope that was, at least gave you all some things to think about. There's lots of stuff I didn't cover, too. Ooh. Yeah, absolutely. I'll answer any questions